Hello and welcome to this week's episode of The Capitalist Investor. As always, you have me, Diamond Hands D, and Tony's on assignment this week, so we have Luke Lloyd.
Apparently it's 115 degrees or something in Scottsdale right now where he's at.
Oh, really?
Yeah.
I saw it was like 100 days over 100 degrees or something ridiculous.
Yeah.
That hit yesterday.
Is it global warming, Derek?
The internet doesn't seem to think so.
No, the internet doesn't?
No.
That's surprising.
There was, who knows if this is true. I was just scrolling yesterday, but there was like a study that came out yesterday that said CO2 doesn't really have anything to do with global warming.
Oh, well.
It looked like an official study, not like someone just tweeting on Twitter. But yeah, so
I'll tell you, the weather patterns are getting kind of weird, though. Like, we had a tornado come through here in Cleveland just a few weeks back. It seems like the rain, like I was just back in my hometown, and I went through two huge pour-down rains. Like, I don't know. It just feels like, I don't know. Maybe it's not scientific. No, it's just anecdotal kind of maybe evidence to what I've seen. Just it feels like the weather is getting worse. I don't know.
It seems that way.
Yeah. But hey, maybe we could leave our conspiracy rants for the end.
All right, we'll talk aliens and stuff at the end of this one. But so yesterday, so probably 2 days ago now, after recording this, Nvidia took a big tumble, huge down day for the Nasdaq as well. So we thought we'd kind of talk about that and kind of seasonality as well. So September historically one of the worst months for stocks, so we'll dive into that quickly. Take a look to see if we think that'll happen this year. So what do you think, Luke, on the Nvidia news yesterday?
Well, it's really around a lot of concerns around seasonality, right? You hit the nail on the head with September. September's the worst month in the market if you go back to like the Great Depression times, like even since 1929. It's even been worse the past decade. So I think it was like since 1929, the September's down usually like a little over 2%. Historically, the past 10 years, September's been down on average a little over, I think, 4%. So the kind of thought process and question we got to pose and ask is, what's September going to look like this year? Is it going to be worse than average? Is it going to be better than average? And I think you have to look at actually the market dynamics to really understand that question. So you have like the Nvidias, Apples, Amazons, Googles, Facebooks of the world, top 7 stocks, Mag 7. They're like 40%. It's like 40% of the S&P 500 and like maybe, I don't know, 50% of the NASDAQ. Like it's like very heavy weightings for those top names. And, they've been the AI plays. And I think investors are starting to kind of digest and think, like, what are they actually going to add the profitability and growth that we wanted to see over the next couple of years? And if you look at actually earnings expectations in the market heading into 2025, as early as next year, the bottom 493 in the S&P 500 are actually looking to deliver the majority of earnings growth in the market. That hasn't happened for years. The top 7 stocks has added essentially all the earnings growth in the market. So I think, this goes back to what we've talked about a lot is it's now a stock picker's market. The bottom 493, you want to start looking at those outside of maybe the Mag 7. You can't just throw money at the wall at the Mag 7 and expect to make money. And I think that seasonality component of it, given the election uncertainty coming up too, I mean, I think that throws a wrench into it. People are taking risk off the table right now. I mean, it's only 2 months before the election.
Yep.
People are taking some risk off the table, reevaluating and repositioning some assets. So I don't think this rotation is done happening.
So we've been talking about this rotation for almost a year now, honestly. And we know we're headed into a seasonally, bad time for stocks in general, but probably specifically for, the semiconductors and chip makers and things like that. How do you think, if we can put the election to the side for a minute, which is difficult to do, but if we kind of see the cracks starting to form in those big 7 stocks, what do you think 2025 is going to look like? Maybe even specifically for the Nasdaq, we don't even have to just say that the top 7 stocks, kind of
Well, I like the question. I hate and like both at the same time the question of what do you think the market's going to do?
Mm-hmm.
Because the market really, in my opinion, in today's world does not dictate actual economic, what's going on economically, and it does not dictate what actually is going on in the market. So most people use the S&P and NASDAQ as a reference point.
Mm-hmm.
Whatever they're doing is what the broad market's doing. Again, it goes back to my point. When you have such a large weighting in a small amount of stocks, can you really even use the indices as a true index for what's going on in the markets? So what I think is going to happen next year is actually what I thought was going to happen this year. I was wrong. I think it actually got pushed back a year because of AI, essentially. I think you're going to see the market kind of be pretty rough over the next year. Like when I say rough, maybe even a negative year next year, like from Jan 1st to the end. But there's still money to be made. I think that you're going to see the indices kind of be volatile. Indices be maybe negative, but though, like I said, the bottom 493 or Russell 3000, a lot of stocks in there. There's going to be a lot of money to be made.
Yep, for sure.
So the market could be doing bad while everyone's making money in other stocks.
Yep.
That's my point there, right?
Mm-hmm. Yeah, that's interesting because we've been saying that for a while, and it's been true to some degree about it being a stock picker's market.
I think you'll see international outperform actually domestic.
Really?
Yeah, I think that's a very big possibility. International just has been significantly underperforming forever, essentially. So I think that U.S. has been the spot to be. So the rotation trade doesn't have to be just from top to bottom, big stocks to small stocks, or top 7 to 493. It could also be from U.S. to other countries because a lot of money has been made here in the U.S. You want to start thinking like, how are other portfolio managers? How are those that have made a lot of money, where are they going to throw money next? And it's very possible they could throw it at other countries, those emerging market economies. India, that was like where the U.S. was 100 years ago from a capitalistic free market standpoint. Their middle class is growing significantly. I think incomes are looking to double by 2030. Mexico, obviously, with the onshoring. So, like, even Brazil, and all these like South American companies, are going to benefit from more onshoring to North America. So, I think you want to look at some of those spots.
Yeah, the international is interesting. We've talked about small caps before quite a bit, and I still like them going forward to basically the points you've just made there. International though is kind of a running joke. It's been on everyone's list to outperform for a while now, and it just never has. I shouldn't say never. I don't know those numbers off the top of my head. It seems like it never has performed over the last 10 years. So
it hasn't. Well, it hasn't.
Yep. So I just wonder. So I go back and forth in my mind all the time on international. I just wonder though what the catalyst is going to be, because they're having some trouble over there.
Well, I think
specifically in Europe.
So there's two philosophies. Well, Europe, yeah, I would not be. Europe's too plugged into the U.S. in a lot of ways. You want to look at countries that maybe aren't as plugged in to where they are the ones actually, exporting to the U.S., not importing from the U.S. So what I mean by that is I think the catalyst could be let me go back to the two philosophies. One philosophy is, if the U.S. falls, it brings down the whole world with it, right? So even if the United States is not looking too hot, other countries won't look too hot either. But there's another philosophy out there that says, if the U.S. goes down, that could be the catalyst for money to flow out of the U.S. and pump up other markets and valuations elsewhere, right? So it's potentially a catalyst that we enter a true recession, unemployment ticks up over here, and money just flows out of the U.S. What is it going to do? Go to cash? Possibly. But if they lower rates, cash is going to be earning nothing. So maybe investors will have a risk appetite elsewhere in the world, and that's going to increase valuations elsewhere.
Yep.
So I think the catalyst could be the negative aspects of the U.S.
That's another great point. Look at you.
I don't know if this is actually going to happen. I'm just, speaking hypotheticals.
All right. Well, anytime there's big movement on Nvidia or, any of the Magnificent Seven stocks, it's always big news. So we'll see if, we'll see if this kind of downtrend continues here in the month of September. Any final words?
Yeah. So I think it's important to tune out a lot of the noise. There is a lot of noise out there, and it seems like the election headlines just get crazier and crazier, and I think it's going to get even more crazy over the next couple of months. So at the end of the day, there's two inputs to the market: valuation and earnings, right? Mm-hmm. So you have to consider, I think unemployment's going to be the biggest key that we have to pay attention to. The rate of change has been crazy from like 3.5% to 4.2% or whatever. Mm-hmm. We got to pay attention and make sure that doesn't continue, because if that does continue, that's when dominoes fall. Delinquencies we talk about, it's going to be very important.
Yep, for sure. All right, well, thank you for listening this week. If you guys have any questions, comments, or show topics, hit us up at info@swpconnect.com, and we'll talk to you next week.
The opinions expressed in the podcast are for general informational purposes only and are not intended to provide specific advice or recommendations for any investment, legal, financial, or tax strategy. It is only intended to provide education about the financial industry. Please consult a qualified professional about your individual needs.